taking photographs of the
Okay, we're done. So thank you for joining us for the announcement of the Q2 results of IndusInd Bank. As has happened in many quarters in the past, we are kicking off the earnings season for the industry as a whole, and of course for all corporates as well. So this has been a pretty busy quarter as far as regulatory news is concerned. I'll quickly take you through those bullet points before I come to the results. Of course, we saw about 21 new banks being licensed during this quarter, 11 payment banks and 10 small area banks. That is big news, and I'm sure there are going to be questions around that. There was a fresh discussion paper floated by RBI on the methodology for calculating the your base rate on the basis of marginal costing and all. That of course has also been a subject of much debate. Two banks were classified as systemically important banks for the first time in the country. That's also made a lot of news. And of course then RBI launched a fresh initiative to revitalize stressed assets through prescribing another proposition which banks are going to adopt in the future. So a very busy quarter as far as regulations are concerned. And of course markets around the globe and domestic markets were also influenced by 2 or 3 factors. One of course was China and the devaluation of the currency, which caused depreciation of currencies around the emerging markets. The rupee of course held up very nicely, depreciated only about 7% or 8% compared to some of the larger currencies like the Australian dollar, etc., which depreciated by almost 29%. So China made headline news. The Fed of course also influenced markets by not raising rates for the time being, essentially I think influenced by the volatility that we were seeing in the markets. And of course the domestic markets were heavily influenced by the fact that RBI cut the base rate by 50 basis points and of course also switched some of the policy stances towards a more sort of growth oriented strategy. So we'll talk about these. If you have questions we can take them up. As far as the bank is concerned, I think the highlights for the bank for this quarter were that we did our capital raising via the QIP route, and about 5,100 crores came in early in July, as a consequence of which the capital adequacy of the bank, total capital adequacy has moved up to 16.5%. The second highlight of course for us was the onboarding of a portfolio which we bought from the Royal Bank of Scotland, which was a diamond portfolio which added about 4,100 crores to our loan book, and therefore you see a pretty strong growth in our loan book at 31%. So the loan book grew by 31%. Other highlights I think are the trending that we were seeing on vehicle financing is now become very, very distinct and sharp. We saw a very good growth in our vehicle financing businesses, as we saw a very good growth in our other non-vehicle retail businesses. So I think after 2 years we are seeing our retail growth go back into the 20%. Retail actually grew by 23%, while overall loan book, as I said, grew by 31%. If you exclude the diamond portfolio of 4,100 crores, we still had a loan growth of about 24%. I think the other highlight is that our interest margins moved up nicely during the quarter. There was a growth of 20 basis points on our NIM, which moved up from 3.68 to 3.88, and you see a reflection of this in the growth of our net interest income, which I will come to in a while. Our microfinance portfolio has moved up very nicely. That's a highlight for us. It processed 2,000 crores, and we are well on our way to grow this portfolio at an annual rate of about 30 or 35%. See, total revenue growth was up 31%. Net interest income of that grew at 30%. Fee income grew by 32%. That was a smart growth, as a consequence of which overall net revenue also grew by 31%. Not only is there a very smart year-on-year growth, but we are seeing also very smart quarter-on-quarter growth as well. So as a consequence of this and the fact that costs were kept under control, did not grow at the same pace as revenue, our operating profit grew by 39% during the quarter, and as a consequence of that, our net profit grew by 30% during the quarter, with a quarter-on-quarter growth of 7%. So those were highlights. You see an improvement in most of our vectors. So NIM, as I said, improved 3.68 to 3.88. ROA grew by 3 basis points to 1.93. ROE was about 16.7%. Last quarter was 20.3%. But that's a consequence of the new capital that came in during the quarter. So these vectors also look pretty nice. The quality of the book has remained stable, in fact slightly improved. The gross NPAs and net NPAs fell by 2 basis points. So our gross is now 77 basis points and our net is 31 basis points. Those are the headline numbers. The other sort of qualitatives I already talked about. We raised capital, number one. We accelerated our branch opening program. Last quarter you saw that we had not opened so many branches because we were reviewing what branches were supposed to do in the light of the digitization wave that is now sweeping our markets. But this quarter we increased our branch network by 43. So we are well on our way to get to the 1,000 mark by March of 2016, as we had said in the past. So I think these are some of the broad headlines. We talked about the diamond portfolio. Diamond portfolio we've already talked about. The diamond portfolio is both in terms of quality one of the best portfolios available in the market. Also it is accretive to us both in terms of net interest margin and ROA and ROE. So this is a business that we, as we always said, very close to our hearts. We specialize in this business, and ABN AMRO of course always had the best of this portfolio, so we are very happy that this is accrued to our loan book, and this accretion is reflecting already in some of our vectors like interest margins and ROA and ROE. I think that's a summary of the headline results for the year, and I'm sure there are going to be a lot of questions, so we can get into details on that.
Mr. Sobti, Nisha Poddar here from ET Now. First of all, if you could throw more light on the factors which led to this expansion of 20 basis points in your NIMs for this particular quarter, and what is your outlook going forward as well? Are these numbers sustainable? How much growth are we looking at?
Yeah. So I think there were a couple of factors fueling the growth in our net interest income as well as our NIM, net interest margin. One, of course, capital came in, 5,100 crores of capital, so that itself gives you a relief in terms of cost of funding. Second, of course, and more importantly, and that's important from the point of view of going forward, is the change in the mix of our loan book. We've always said that ideally we would want our retail to be 50% of our book. Because of the slowdown in vehicle finance over the last 2 years, we had seen retail percentage fall. We fell from 49% to about 41%. And now if you take out the diamond portfolio, the retail book has gone up to 43%. So our target of by the year end balancing the book as close as possible to 50-50 now looks reachable, because we are seeing a very good traction on both vehicle financing and non-vehicle retail financing as well. So we don't give forward-looking statements, but I think as this mix changes in favor of retail, the yield structure will improve beneficially, and therefore we expect that there should be a beneficial impact on the interest margins going forward.
What about your base rate and deposit rates? How did they stack up after the RBI's 50 basis point rate cut? And could you mention about that ongoing debate on marginal cost of funding which RBI has proposed, and it could be a reality in April 2016. So
yes.
Which side of the debate are you on?
Yes, so cost of deposits have fallen, and we had reduced our base rate earlier by about 15 basis points. ALCO has already met, and we are going to shortly announce another reduction in our base rate. I can tell you now because that will be in advance information, but the ALCO has already taken the decision that we will move it significantly down next week. That announcement will come. So base rate has gone down, but you know, we have transmitted the lower cost of funds already, and you will see that our yields on the corporate bank, for instance, and the retail bank have fallen.
And deposit rates to maintain margins?
Yeah, deposit rates, you know, deposit rates have been falling. There's no denying they've been falling for the last, 90 days or 180 days, 2 quarters. Deposit rates have been cut even further. And so we expect that while we keep our interest margins intact and maybe improve because of the change in the loan mix, the actual yields may fall. So yields may fall, but I don't expect that interest margins will shrink as a consequence of that. So we're going to fall in line with the market. You will see a significant, as I said, decrease in our base rate to be announced next week.
And deposit rate as well.
Of course.
And one more thing on asset quality.
You said about marginal costing. There was another part of the question. So, you know.
How will it impact your?
Yes. So, you know, we've always had a hybrid between marginal costing and average costing and all. So we are fully prepared to move to marginal costing. So our computations actually, which will lead to the reduction in the base rate that to be announced next week, is the consequence of the marginal cost of funding. So we are already moving to that aspect. We expect that to become a reality, and internally we've already made it a reality.
And your asset quality has improved this quarter. Can you throw more light on that?
Yeah. So, you know, the 2 books have are behaving well, and clearly on the retail side, we are seeing a drop in our slippages. So vehicle financing, because of the improvement in the economics of the transport operator, because of freight rates holding up, number 1, and 2, because of the drop in the diesel rates. The diesel price rates, they've dropped by almost 15 or 16 rupees, which means about 16,000 rupees more in the hands of the operator per truck per month. You know, so that is certainly reflecting in a reduction in days overdue, also reflecting in a reduction in our cost of credit on the vehicle finance side.
Sir, Devi from Reuters, just to be clear, did you say you aim to grow your retail loan book to 50% by this financial year?
Yeah, I think at the end of the year, we may be around the 48% odd mark, 48, 52. Right now, it is actually 43, 57%. Sorry, there was a question.
The question was from me. Just looking at the other income number, it's grown quite significantly compared to last year.
Yes, yes. Maybe we can show you a slide that really gives a breakup. We do declare the constitution of our fee book every quarter. So if you see the presentation, investor presentation, which is already uploaded up on the site as well. But just to take you through that, it's split over 5 or 6 lines, and those 5 or 6 lines in turn have another 8 or 10 lines under them. So, you know, the very, very sort of variegated fee lines that we see. But the broad headlines are really these 6 sort of vectors. So you see that most of them have grown. The general banking fee, of course, depends on, you know, minimum balances maintenance and things like that. But there is a new RBI guideline on that you have to give a 60-day notice now before you charge somebody for not maintaining balances. So that's a consequence of that. But that's only a 60-day lag that's happening. But all the other lines are moving nicely. And I think the smartest move that we have this quarter is really on the trade and remittances line. So we've got good flow on the trade side, trade-related letters of credit, guarantees, etc. So that business has done well. FX has always been a good sort of mover of a fee needle. And that has done well. All the other lines also look, I think, pretty decent double-digit growth everywhere.
Also, the outlook for the asset quality, I mean, you said why it has improved, but what does it look like for the next 2 quarters?
I think we are going to see stability there. We are certainly going to see improvement in the credit costs on the retail side, especially on the vehicle finance side. It's very perceptible testing. Overall, we expect a stable cost of credit is what we measure. You know, that's the most important part of it. Gross and net NPAs at these levels are, you know, not so meaningful. You're already at 0.7% in gross and net 0.3%. But cost of credit is what we monitor. And I think that cost of credit will be in the vicinity of what we have seen in previous years.